The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour, and I'm back. Been away, had a very nice break. It was nice to be able to just get away from things, although, as my subscribers know, I did my work just as if nothing was happening every single day. They got their very detailed report of my opening call. We got some positions on, which seemed to be working very nicely. And but I did take a break, and it was important to do that, and it was enjoyable. So I'm now looking at a market that has gone. You remember we spoke about the volatility index, the VIX index? What I said is holding in the mid-20s, very negative, going down to 20 or below would be very positive. Well, today, even with this sell-off, market is down only 30 points. And the volatility, the VIX index has gone to a lower low. Let's just have a look right here. Yep, the VIX has gone down. Today's low is 19.44. It's trading right now at 19.88, down $1.23. So it's made, let me just double check, 1944, the previous low was 19.87, so it's gone to a lower low. And most importantly, for those of you who are looking at Tiger TV, let me just go through this because it's been a little while since I was here. Let me cover the ground that I think is important. I'll just first say that the Dow's down 26 at 12,740. The comp index is up 8 at 2880. The S&P's up 3 at 1345. You've got gold down 4.70 at 1623. Silver's down 10 cents at 2864. High-grade copper is at 338.65. Last night it had a big pop, and then it pulled back. So now it's still not great, but it's trying to find some kind of a base. Crude oil is at 83.22, down 81 cents, and bonds are only up 4.30 seconds at 149.25, 30 seconds. So let me just go through. This is what my subscribers get every single day to my opening call, and I'll explain why I think it's so important that they get it and why. I use all these different techniques, and the techniques, many of them are proprietary. I've developed them over the years just through experience, really. I mean, I haven't done any software adaptations to be able to run. I've done some, but mostly I haven't. Mostly they're just chart patterns that we're looking at. And what you will see, the five quadrants. Sounds like click and clack when they say the first half of the show is done, and the next third will do whatever it is. So what we're looking at here is that in the 120-minute chart, this is the 120-minute chart if you're looking at Tiger TV, there was a beautiful left side, right side price time match which went right to the high at 11:30 on the 11th of June to 12,649. Then it pulled back, started a brand new buy mode, and that buy mode, in fact, has gone to leg E, which we are in right now, and made a new recovery high today, 12,781. And what I said here, this is what I type in, just over the 200-period exponential moving average. So support is now 12,700, 12,660s. Today's low was 12,696 so far. That's the area, containment area. So far, as I say. And then I said the resistance is at 12,790 to 12,830s, and today's high is 12,781. So it's right in that range. Then I said here that at 2111, the close on Friday, the volatility index, the 120-minute chart, is still way underneath the 2773 peak that it made back on the 4th of June, which also started off the big rally here in the market. And this is a pretty darn good rally, 700 and something points in the Dow. But look what's happened. The volatility index has gone and made that pattern that I call the dreaded H. What is the dreaded H? Well, if you have my CD introducing the ChapmanWave methodology and the pattern that I was discussing when I did my all-day workshop 2 Fridays ago, the pattern that I was looking at is called, well, I call it the dreaded H. It really just looks like an H pattern. And that H pattern says that at any particular point, and I'm showing you my CD here introducing the ChapmanWave methodology, only available here at TFNN. Let me just find it. So this is chapter 17. So we go to chapter 17, not overlapping waves, but the dreaded H pattern. And just before the right arm extension and the instant restart. And this explains exactly in great detail what the pattern is. And it says that when the prices pull back sharply, there could be an H pattern. And that H pattern says if you break and close underneath the left side low bar, and the technicals are also weak, but it's also the chart pattern you're looking at, be careful because it could go down even deeper. So what do we have? We have right here, we have the H pattern. This is a large H. Why is it a large H? Because the rise from 19.87 to the recent high of 24.93. Let me just type that in. I always like to have these numbers ready. 24.93. That was a very big 5-point move. Hey, that's 20-something%, right? So what happened was it ran 20%, and then it came charging back down to today's low. That says to me, remember what I said? It's not about currencies. It's not about the bonds. It's not about yields. It's not about anything else. It's about the volatility index. If the buying pressure remains, and that says it remains if it's under 21, preferably under 20 in the 19s, that buying pressure will constantly find support. And that, to me, says that the leg that we're in, which is leg, now let me go to the other, one of our quadrants of the 5 parts that we have here. My ChapmanWave trend indicator, this is a trend gauge that I developed. It has nothing to do with Richard Arms, except I happen to use his information. I have certain levels that I watch on the upside and the downside, and when they hit those levels, it says either, number one, that within the very next session, if it's very low, there should be what I call a rug pull, some move, no matter how much the futures are up beforehand. And remember, I called it a miss the other day, even though the futures were up huge and the Dow went up 160 points before it pulled back to only plus 57. That was a huge pullback, but I didn't count that in the record that I keep. That was a miss, even though it really was a fantastic move down and a great insight in this particular gauge. That said that today there should be some selling before there's a rally, and it's exactly what happened. Even though the futures were up 8 or 9 points last night. It's just, I don't know how that works. It's just a fabulous indicator. So, once again, we've got a good success rate on this trend gauge, and there's leg C up in the daily Dow. Well, if you know the ChapmanWave methodology, that methodology says that if all the technicals are strong and if you've surpassed the left side peak of consequence, now in this particular case it was the peak of 12,611 at the close on the 29th of May. If you succeed in breaking above that, especially if it's only leg B and then you've got a C to come, there's a really good chance, and I mean a really good chance, meaning, boy, I'd put it at over 90% chance, that you're going to get at least a leg D to the upside. But two things are happening here. One is that from the 12,035 low, that's a 1,300 point decline from the 13,338 top of May the, what was it, was it June or May? Of May the 1st. This rally is actually quite strong, much stronger than one would have anticipated, especially with all the bad news out. So I consider that as far as the Dow is concerned, there should be a peak C to come, could be in the next day or two, and then there should be a leg D. It doesn't tell me how much. It just says keep looking at the left side for your target areas. So looking at the left side, the next target area would be somewhere around the 12,820 area, 12,820, 12,840. 46, something like that. But the S&P has also made a leg C, and it also surpassed the peak that it made back on the 29th of May. So that, and it's not as strong in the chart formation as the Dow, but that says that the S&P also should at least try to attempt a peak D. So that's positive for this week. Regardless of whether there's a pullback which we were anticipating. Now, what's really important about this is that I suspect that the volatility index, the VIX index, is going to go back to about 20.60, 20.80, and then maybe touch 21 and then pull back under 20 again. But if in the next rally, the volatility index, peak D is the peak D is still to come, but peak D says that the high of today, 12,781.93, I can't call that a high. It's a question of the debt. I cannot call that a high for the day. The day is still only 2 hours, not even 2 hours in. I have to wait for the end of the day. But it says that if throughout the day we don't make a new high, then probably going to pull back Tuesday. And by Wednesday, we will make a nominal new high. I'm saying nominal new high at this particular point, but I'm going to show you some other aspects. So those 5 sectors that we looked at, 120-minute chart of the Dow says leg E up. There should be a pullback at some point, and there was, but it's still a new recovery high, so I haven't made a peak E, the 120-minute chart. Trough F/C in the VIX index is still under 20 at 19.97. The TRIN index is at 1.56, showing that there is selling pressure, and the price still went up in the Dow, which is a very good sign. And the S&P today made a new recovery high, 1346.59. So put that together. Now I'm going to show you something else that I show clients. And, of course, with all this text that I've written here, I still write a whole chunk of text here for my overview and market today section. And then I go to, I've been including this lately. I included it already because it was a lead into for the folks that did my all-day webinar. But I've decided to keep it because it's just so important the way I use the technicals. Look, this is the MACD here, MACD, 12.26.9 of the parameters. This is the slow stochastic, 14.331, 20%, 80%. And it's right now at 95%. So that says that the Dow, the DIA, the Dow Spider ETF, is acting really well. What did it do? It went down to a low today of 126.65. Where is the 9-period exponential moving average? These are things that I do in my newsletter every single day because I want my subscribers to understand the thinking, the methodology, and the techniques that I use. The 9-period exponential moving average at 126.65, held by 1 penny. So far that's very good, but I still believe that we're going to have some kind of a pullback under the 9 EMA, either later today or tomorrow. That's just my thinking. And then I also do this every single day. I show the Dow chart, how positive this left side, right side time price match was, because on Friday, it broke above the 12,720, 12,710 resistance area, going to 12,774, and today we went to a higher high of 12,781, and that's very positive. So as I say, I expect that there will be somewhat of a pullback, maybe 1 to 3 days, and then we make a new recovery high. So that's what I'm looking at there. Now, this is also very interesting. In the E-minis, and this I show every day as well, I usually show the 10-minute chart. Here's the 10-minute chart, made a peak D with that spike to 1346.50. Late last night at about 6:20, just after the market opened overseas. It's pulled back down to a low of 1327.25, spiked just now to 1340, and now it's pulling back and digesting those gains. Here's the 120-minute chart. I'll be right back to take your calls at 877-927-6648. We've got Lou and Nashua waiting patiently.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you gain access to each host charts and computer screen as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, Dave White, Larry Pesavento, or Victor Jones, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV yet, then visit TFNN.com today to see what you're missing.
Stock market corrections are the number one reason that a buy and hold investment strategy produces the poorest results, and I have 73 years of data that proves it. Now, the good thing about economic difficult times is that the worst economy can produce the best rewards in the shortest period of time. In fact, during the last 130 years, 61% of that time period has been spent in recession. And if you're one of the 70% of American households relying on their 401ks and IRAs for retirement, you need the single strategy that is bulletproof against the turmoil of our stock markets. Go to the homepage at TFNN.com. Under Breaking News, click on Success is a Numbers Game to receive this must-have free report. This bulletproof strategy may be days away from giving the next signal. Don't neglect your retirement, and don't neglect this signal. If you're even a little bit interested in accumulating wealth, providing a better life for you and your family, then go to TFNN.com to order your free copy of Success is a Numbers Game today. Implement the disciplines contained in this report, and success will be yours for the taking.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her small cap roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now. It's that time of year again, and the Great Panther Silver Summer Silver Giveaway is back. Every day in June, Monday through Friday, we'll be giving away a Great Panther Silver 1-ounce silver bar, and all you have to do to enter is visit the front page of TFNN.com and fill out your entry. Great Panther Silver and TFNN wishing you a great start to the summer. Sign up today to have a chance to win a 1-ounce silver bar during the Great Panther Silver Summer Silver Giveaway the whole month of June at TFNN.com.
This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
Hi everyone, Basil Chapman. We are back, and we are back, and at the same time, we're looking at it down now. That's down 37. S&P's down 231. I find it fascinating because the most important thing about the market today is that there was just a fabulous move. I'm not sure how many people really thought that Friday would be as strong as it was. But when I looked through all these different charts on over the weekend, I said to myself, wow, that was very impressive. There were stock charts that had started to move substantially higher from their lows, and they were the stocks, like the XLF, that or the sectors that had been very poor before. So while the XLF, the Financial Spider Selects Financial Spider Fund, has stopped dead right at the 200-period exponential moving average, having moved off the 1330, I think it was, 1330 low of the 4th of June, all the way to 1437. That's a point it hasn't had that kind of a move for quite a while. I thought that was really nice action. So I'm going to go through a couple of things that we'll look at. We'll look at bonds. We'll look at different aspects in a moment. But I want to go to Lou in Nashua, who listens to us on 1590 WSMN. Hi, Lou. How are you?
You
doing well?
Yes, not bad at all.
Good.
Just wondering when a good time to short the S&P.
Okay, so we're looking at the SPY. You would do it via the STS, probably? Is that correct?
Right.
Okay, I'll tell you what I'm looking at here. Because the Dow and the S&P went a little higher than I anticipated in what I thought would be a bounce, I have to say that going from 127.14 to today's high of 134, that's 7 points. You have to call that more than a bounce. Although if you're looking at the weekly and the monthly charts, yeah, it's a bounce. But boy, in the daily chart, that was pretty darn good action. Not only that, there's a potential. I must just check here. 129.86 was the high of the 1st of June, and 129.93. Yeah, there's an island reversal in the S&P, in the SPY, that is, from the 6th of June. So I have to be impressed with that action just simply because what it says is that not only was there power to the upside, but normally what you would get is a retest, and so far we haven't got the retest. Now the MACD, the moving average convergence divergence that I like to use, is still expanding. The histogram is very strong, and the stochastics at 86%. So this is what I'm going to recommend to you. I believe that you're correct at this particular point. I still have to consider that this is a counter-trend rally to the major down move that the weekly and the monthly charts had shown technically. But the month is not finished, and that to me is very important because anything can happen. And if you're looking at my charts in the Tiger TV, you will see that the SPY, when it went to the most recent high of 137.18 back in April of this year, then pulled back to the 200-period exponential moving average. It went to a higher high. That higher high wasn't really accompanied by the technicals, the MACD and stochastic, going to higher highs, but they did rally pretty well. So my thinking was earlier, before I went away on vacation, was that if there was a rally, the fast-moving average of the MACD, this is the monthly chart, that's the yellow line above the red line, that's what's called the 9-period moving average differential between the 26 and 12, that's how it's made up. Until that crosses negatively, I have to say that the monthly chart is still holding very well, and the stochastics at 87%. So no matter what I think, the reality is that up until right now, as we're talking at Monday, June the 18th at 11:30 Eastern Time, my monthly chart has not given a signal, other than it was a peak E, to say that this is going to be a decline that plunges down to the 122, 120, or even 118 area. I can think it, but I have no veracity. I don't have any conviction yet in the technicals. But on the weekly chart, this looks very much like a retracement rally failure mode. This is new leg A, and I call it gray A, meaning it is substantially under the previous peaks. The stochastic is rallying nicely. It's at 31%. It's only at 31%, but it's rallied very well. But 31% is not strong at all, and the MACD is still kind of flat. So give me a moment. I'm going to put a couple of things together to give you your answer as to where I would consider shorting in a moment. But we'll be back. We've got a break for some commercials, very important to TFNN. Be right back soon after these messages. Hold tight, Lou.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks.
Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations including precise stops and target profit zones, leaving nothing left to guessing. Log on to TFNN.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. Has the current market volatility continued to stop you out of trades when temporary market spikes move against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the advantage of keeping your trades open even when the market temporarily spikes against you. Nadex's innovation has allowed them to come up with a line of unique short-term binary options that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN has just launched our most exciting sale ever. If you purchase any amount of Tiger Dollars before Sunday, June 24th, you'll receive access to 7 live 90-minute webinars hosted by each of our technicians here at TFNN. Not only do you get a 20 to 30% bonus on your purchase as you normally do with Tiger Dollars, but with this one-of-a-kind offer, you get over $1,000 in added value completely free. Each 90-minute live webinar usually sells for $149, and you get all 7 of them absolutely free. Tom O'Brien, Steve Rhodes, Basil Chapman, Larry Pesavento, Ken Shreve, Dave White, and Kate Stalter, you get all 7 classes completely free. Whether you're an experienced trader or you're completely new to the markets, this sale is perfect for all levels of investors. Don't miss out on our best Tiger Dollar sale ever. Visit the front page of TFNN.com today and purchase your Tiger Dollars before June 24th. Don't wait and risk missing out on this one-of-a-kind offer. Act now.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Hi everyone, Basil Chapman, Tiger Technicians Hour, and we are on right this moment with Lou in Nashua, and we are looking at the SPY, and the question that Lou had was, when would it be appropriate, or where would it be a good chance to go short the SPYs with the least risk? I think that would sum up the question. Correct, Lou?
That's correct.
So this is what I'm looking at. Because the euro has pulled back very sharply after being much higher late last night, because the bonds are not showing tremendous strength, they're showing strength in the sense that they've gone from the bonds, this is the USU, this is the September bonds, have gone from a low of 146 and 28/32 back on the 11th to today's high of 150. that's strength, but it isn't the technical strength that I would have liked to have seen, not at this particular point, although having made a peak F in the daily, there's no question that it needed a timeout, and I believe that Wednesday, Thursday, Friday of last week, the fact that bonds didn't go to lower lows tells me that, like the volatility index, and that's the only reason why, on the one hand, I'm looking at specific, what I would call U.S.-centric stocks that have nothing to do with Greek defaults or Spanish, whatever. They are just looking at the strength here in the U.S., in their particular sector, in that particular stock. Whereas if you're looking at stocks that have a European, some kind of a weighting that takes them to Europe, however it is, whether it's a currency, whether it's through exports or imports, that to me says is much greater risk. But the volatility index having plunged, even now it's down near the lows at 19.47. You can see the market, theoretically the market should have been down, should have stayed down 70 points, S&P down 8.30. That's the way it should be right now. So I'm suspecting that within this market there is internal strength that is not yet being resolved. The way it's going to be resolved, and I think it could be a real easy thing, is you can look at two things. One is, I'm just going to pop the dollar up here for a second. The dollar has had a very nice intraday reversal, but the weekly and the monthly, the weekly and the daily are saying that there's a good chance that the dollar is going to do a little bit more testing, and then we'll see. It's the chart pattern isn't as strong as the bond chart, daily chart, but the weekly and the monthly are still holding pretty darn well. So this is how I'm piecing it together. On the SPY, and you can use the SPYs, I think the context of using the SPY is good. The SPY 120-minute chart stopped right on 134.70 is the 200-period exponential moving average. I don't know if you ever use, do you ever use the 200-period moving average?
Yes, I do.
Okay. And if you're looking at the exponential moving average, it became tremendous support way back in early May, and then back on the 2nd of May started to turn down. And look what happened. That became tremendous resistance. Even the spike up last week on the 11th stopped dead at 134.25. It couldn't get to the 134.65, I think it was at that point. Oh, no, it was a little higher, 1.78 level of the 200-period moving average. But if you're looking at the stochastics at 90% and the MACD is flattening out at the top, and that says there is still internal strength. So here's what I'm looking at. I suspect that the SPY is going to pop above the 200-period moving average somewhere toward the it's at 134.09, somewhere to the 135.40. I could even see it going to 135.73 area. And at that point, not if it's leg C, I want one day with a lower high bar. If it goes to leg D and it gets there and then it starts to stall and the volatility index goes back into the 20.50 or 21 area, to me that would be the best opportunity to go short. But I, at this point, still think that there's going to be a leg D. So it isn't today, and therefore it couldn't be tomorrow, because there has to be a peak. If tomorrow sees no new high bar, that's a peak C. Then I want just one pop-up. What would be ideal for you to short is if, say, on Wednesday, you've had a weak session on Tuesday. On Wednesday, there's just some news that spikes the SPY to a higher high. Let's just imagine that today's high of 134.57 is the high for the day, and tomorrow there's a lower peak. That means that if it goes to 134.58, that starts leg D, and at that point, if you start to see the internals weaken intraday, like at 11:20 or 12:30 in the afternoon, at that point you can you can buy the SDS, and all you need to do at that particular stage is make your stop 1 penny above that leg D high, because you won't have made a peak yet, because you'll be preparing. If it goes above that, I would wait, because there's internal strength that's going to go high. It could even go to an E or even an F. So let me just clarify. If there's no new high today and tomorrow's weak, then Wednesday or Thursday, if there's a sudden pop-up, and an intraday reversal. So it means you're going to be at your computer. If there's an intraday reversal, as it's reversing, I would put the SDS 200% short position on, or short the SPY, and I use a buy stop of 1 penny above whatever this whatever the high of leg D is on that day when you short it. So you might only be out 20 cents or 23 cents, but your risk reward is fabulous, because if on Thursday or something there's just really bad news, you've got the position that says, wow, I can very clearly see that 132.83 is the SPY support. If it closes under that after making a leg D up, that could be a really opportune time to be short. So it could be this week, or if it just keeps going higher and there's no intraday reversal, you hold off. So small position, and if it starts to take out 132.80, you can even add to that position. But I would say it has to be after leg D. You'll miss it completely if it actually turns around today and tomorrow plunges, because you've missed that opportunity. I'm expecting a leg D. It doesn't have to happen, but all the technicals I'm looking at say that there should be a D. So, and look what's happened with the Qs. The Qs are right now making leg C up, and their stochastic's only at 75%, but the MACD is still very strong and is acting quite well. So I really do think that there's still internal strength, and that internal strength has to be, it has to dissipate before you can really have a secure short position. So even if you put a short position, I would still make it a fairly small position. I wouldn't add to it unless the level that I was speaking of, what is it? I think 128.57, I think I said. Whatever that level is that is taken out, then I would add a little bit more. So I hope that helps you.
It does, Basil. Thank you.
Thank you very much for calling. I do appreciate that. So, folks, let's just go through this. We're looking at the Qs. In the 120-minute chart, there was a peak D. Remember how many times we looked at these peak Ds, and it pulls back from the peak D. That's on the 120-minute chart at 11:30 on the 11th of June. It pulls back, makes a nice sideways consolidation, makes a new recovery high. Now, what I had gone through with my attendees to my 66.80. I'd shown them that the cup formation, even though you go to a new high in the cup formation, always look to the left, because it could be a leftover. This peak that was just made could be a leftover E that was still in place because it was still internal strength. Or you can use your count to say in the Qs, the 120-minute chart, let me just double-check, 49, so that's 44, that's A, B, or it's E/C. And this is what I call a gray. I should change the color. I don't have time right now. So, and that's the way I have it. And you don't have to do anything about it. You say, okay, potential double top, but that 200-period moving average looks really like a magnet because it keeps getting closer and closer to it. So I suspect the 63.89 area will be hit sometime this week. I'm suspecting, I don't know, but the stochastic's holding really well at 91%. This is the 120-minute chart, and the MACD's expanding. And if you look at the daily chart says that the on-balance volume is good. That's the green line. The MACD is strong. So it says that at this particular point, there seems still to be strength in the daily. But the weekly chart, and this is the thing that concerns me, between the Qs, the QQQ Trust Series, and the NYA, which is the 2,800 or something stock, very broad market index, the New York Stock Exchange. See, that weekly chart is also is stopped right at the 9-period moving average resistance. The MACD is improving, but it hasn't really turned up at all. The fast-moving average is still not even flattening out. And the stochastic has gone from under 20% to, I think it was 8% or something like that. Let me just double-check. Yeah, 8.81%, and is now at 24.9, so 25%. So it is improving. But that's nothing. I want the stochastic to be up in the 67, 73%, and the MACD and the stochastic and MACD in the monthly chart is not good at all. Look at the way it failed. It deflected lower, and the stochastic in the monthly chart back when it made that last high, that peak A high at 83.27 in March of this year. Look. You had fading technicals. So unless the price is saying, hey, the technicals are fading, but I'm going to hold up, give the technicals time to re-energize so that when they re-energize, they can really push me higher. I'm saying, hey, the weight of evidence says the New York Stock Exchange is way weaker than it should be. Now let's look at another index, the IWM I was asked about. IWM is the Russell 2000 ETF. It stopped dead right on the 200-period exponential moving average of 77.53. Its high today was 77.56. It took it out by 2 cents. Now it's under it. The stochastic's only at 68%. The MACD is improving, but that weekly chart is really weak. It went from WEEK to WEAK. I don't like that, but the monthly chart says, even though it's deflected lower and the technicals are weak, the price is trying to hug the 9-period exponential moving average. So when I put this whole thing together, I'm saying to subscribers, you can lighten up a little bit on these rallies. You can take some cash out. Cash is not a dirty word. It is a good 4-letter word. Build up some cash position. Why? Because those spectacular stocks that have had huge run-ups need some time to digest the gains. Some of them won't go back to the recent highs. Those might be hat-trick highs. But at the same time, I'm seeing a rotation. That rotation says there are sectors that are absolutely on my watch list. For instance, the home builders, the Philadelphia Housing Sector Index. Monthly chart is exact opposite of the NY, the New York Stock Exchange chart. When it made its most recent high, not its most recent, when it made a high back in February of last year at 120.81, this is the HGX Index, Philadelphia Housing Sector Index, the MACD was still rallying and the stochastic was not that great. On this last move up to 134.48, it was spectacular. MACD is strong. The stochastic's at 69%. Is that right? 69%. That can't be right. It has to be 89%. I was just going to say that's impossible. It's at 89%. Hey, I like that. Look at the weekly chart. The weekly chart has had that consolidation that I call an oval consolidation that says, if the stochastic and MACD start to improve here and the price can go over the previous peak, that's the peak of 129.20, made in June, the week of June the 1st of this year, wow, it could retest the high of 134.48 and could even start that stalk leg pattern. This is a long leg up. This is the body of the stalk, and the neck could begin at 134.49, but it's still only at 124.76. So that's really ambitious. So at this particular point, all I can say is the weekly is holding really well. The technicals failed, but the price is holding above the 9-period moving average. And the daily has that pattern that I call the falling axe. What is the falling axe? Well, the falling axe is a pattern that it's a variation of others' flag pattern, but I really call it a falling axe because it looks just like an axe. It's a declining cone or wedge formation, chapter 24. Let's go to chapter 24, and I'll explain exactly what's going on. Chapter 24. And that's it. And all you have to look at is how when it retests the previous high, it can really make a spectacular move. Sometimes it can have a whole series of up moves, but the most important thing is to remember that when the difference between the higher declining trend line and the lower declining trend line is pierced, first of all, you immediately look to the left side peak, and then if it takes that out, you can get a 1-to-1 extension to the upside. So I'm watching the housing sector index really closely because it's part of this rotation. And if in the rotation, you can get our domestic housing sector, if you can get domestic stocks like certain, I don't want to mention any names here, but certain maybe a food stock that is just purely domestic in the sense that it has no very little foreign market exposure. Things like that. I believe that's a good Home Depot. Maybe that's one of those. How's Home Depot doing? Home Depot doing beautifully. High-level consolidation, potential double top in the weekly. Monthly is still very, very strong. Hey, I like to see this sort of thing. High-level consolidation. Home Depot is acting very well. So, Basil Chapman, 877-927-6648. I'd love to take your calls. And please don't forget to go to the front page. Check out the special Tiger deal. You get Tiger dollars. You get 7 free workshops. That is unbelievable. I'll talk about that when we get back.
Put the power of the ChapmanWave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's ChapmanWave methodology for several years now. His ChapmanWave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the ChapmanWave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his ChapmanWave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit tfnn.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to tfnn.com today. Don't miss out on this great offer. Act now. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to tfnn.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Great Basin Gold is a mining company engaged in the exploration and development of 2 emerging gold properties in Nevada and South Africa with a total resource base of more than 23 million gold ounces. Great Basin's Burnstone mine in South Africa opened in February of this year with a resource of 20 million gold ounces, becoming the first mine to open in the historic Witwatersrand Rand Basin in the last 30 years. The Burnstone mine is projected to have a 25-year mine life and is fully financed with production anticipated to be over 250,000 ounces per year at a cash cost of only $450 per ounce. The Hollister mine in Nevada became fully integrated in the 4th quarter of 2010 with annual production estimates of 110,000 ounces of gold per year over the 8-year mine life at a cash cost of only $527 per ounce. Great Basin Gold is cash flow positive and trades on the Toronto and New York stock exchanges under the symbol GBG.
This segment is brought to you by TFNN. Test drive all the newsletters for free at tfnn.com.
All right, folks, now don't forget, go to the front page. You will see Tiger Dollars. But it's not just you get a great deal with Tiger Dollars, but it's not the Tiger Dollars. It's the fact that you get 7 workshops. All of us will be giving workshops over the coming weeks. Mine, I believe, is in August the 15th, Wednesday, I think, August the 15th. And this is just invaluable experience. And to get it for free is just amazing. So use your Tiger Dollars wisely. It's going to be just to your greatest advantage. Now, let's just do this before we run out of time. In the den, Mike has a UNG, and you know what UNG is? It's a natural gas ETF, U.S. Natural Gas Fund. very strong, made a peak. Look at the way these techniques work. In the ChapmanWave, it declined, it made a left side, right side price time match and broke out above it and leg F. Peak F is where you've got to be most careful. And what happens at a peak F? If the technical start to fail, as it's making that, you can make a pattern that's called the dreaded H, that lowercase h I was talking about earlier, and then you can plunge down. That's exactly what it did. It went from 19.76 to 4 days ago. It made a low of 15.18. Hey, that is a pullback. 4 points. That's a 25, 20 something percent pullback. Now it's in a very strong leg B up and the technicals are improving. So I would say that if natural gas holds 17.20 to 17 over the next 2 days, there's a really good chance that if it pulls back, makes leg C, you could even anticipate a leg D. And where would my target be? It'd be right in the gap, right at about $18.58. It's at 17.99 right now. So I don't know if it'll go all the way back to the previous peak, because you've got to go step by step in this methodology until the technicals are really improving. And at this point, the day is young. It looks great, but the day is young, so I can't really talk about it in terms as if it had closed. Now, looking at the Investors Business Daily over the weekend, going through just, most of the 50 stocks. From the top, LQD, which is Liquidity Services, which is at a spectacular move to the 66.57 high of last month, is making that lower peak, the lower high bar this month. So I'm watching this closely because it's made a double top at peak F in the weekly, and is at a pretty darn good pullback from this drop bucket formation at 66.57 peak F in the daily to the retest at peak D under the previous high. So I'm watching, because if it closes, there's that Roman candle, and when it starts to fill in this Roman candle, I would say that if it breaks down, it means it's going under 55.09, under 55. If it does that, you can rest assured that it's going to retest the 52.51 low of the 17th. On the upside, this is still a rectangle formation or two U-shaped formations. So if you're looking at this in terms of where could it go to on the upside, this market is holding really well so far. If it's able to break above 60.81, it could retest the whole of that candle of 63.99 from the 12th of June. That's number one. Number two is Questor. Oh, man, this one, I missed it on the way up, and I missed it on the way down. Leg E up in the daily, leg D in the monthly, and leg D in the weekly, and it's still acting really well. This thing still has strength. So far, it says to me, it's getting closer to some kind of at least a short to intermediate term top, but it's not there yet. If you're looking at CXCI, number 3, and I love going through these in the order that they have them. Look, this is making leg D today with a potential double top. So if you put this together, just with the top stocks that I'm looking at from Investors Business Daily, what I'm seeing is that they're all at a point that within a day or two, either they're going to stop dead because they're bumping into double top resistance, or they're going to break out spectacularly. And that should happen by Wednesday or Thursday. If they break out spectacularly, this market has legs to the upside. If we get some kind of reversal that takes the Dow below 12,450, then you've got to say, back to a timeout, and that VIX index will go right to the 23s again. Keep that VIX index in mind. Thanks for being here. It's great to be back. Stay tuned for Larry Pesavente. It should be another wonderful show with Larry. And then, of course, you've got a great show with Dave White and Tom O'Brien.